Trade Desk, we'd like to welcome Duane Lowry to give his comments on the August 11th USDA report. Go ahead, Duane.
Thank you, Kevin. Thanks to everybody with DPP Grain Desk. We're creating a webinar here post-USDA report from this morning on Thursday. It's currently about 10 o'clock. I'll give you a quick update on where prices are as we speak, and then I'll give you an update when we're done so you can take this all in context. First of all, markets were expected to open sharply higher. They did. Corn was expected to be limit up, did trade limit up. But I think it's interesting, corn was almost immediately trading. It wasn't locked limit. We didn't build pools, which has been somewhat the market's characteristic over the last couple of years on these type of events to do that. And as we speak right now at basically 10 o'clock, corn's up about 28. Beans are up 37, wheat's up 23. So with that, for a start, so you understand where we're at as we speak here, let's go ahead and start. This post-USDA report, I think it's important that we focus on the big picture and we don't get caught up in the emotion of the moment. We focus, as a producer, you need to focus on profitability. And a lot of the presentation here today, after we get done talking about the numbers, we want to try to take today's information, today's report, put it in the proper context, put it in a historical perspective, and something that at the end of the day we hope we've given you some insight into helping you make a decision and help you draw the focus in the right place to make these decisions. Today's report, we're just going to quickly touch on some of the highlights. By the time you guys watch this webinar, you'll probably be aware of some of these. The old crop corn carryout, pretty much unchanged from what was expected, no big deal there. New crop corn estimate, 714 million carryout, not that much different than the pre-report estimate, but how they got there I think probably is important. They lowered acreage, they lowered corn exports, they slightly lowered ethanol usage, almost like they had to back into something that became workable. So as we talk about this a little bit later, that figure is important because of how it was arrived at. Old crop soybeans, 230, that's a little bit higher than what people expected. It's quite a bit higher than last month, but trade was anticipating that. New crop carryout of 155 million on corn, below estimates. There again, a big reason for that is of how the USDA got there. They lowered production by 2 bushels an acre. They also lowered harvested acres on soybeans by 500,000 bushels. So that's a pretty significant number in regards to how we got there. The wheat data for the U.S. Pretty much in line with estimates, pretty much in line with a month ago. On its own, certainly a non-event. On the production side here in corn, you can see here that the total production is 12.9 billion. That's 153 bushels an acre. That type of yield has been talked about in the trade, and I think FC Stone even came out with a number very similar to that. But in terms of what did the trade expect from USDA, they did not expect USDA to be that aggressive. They expected them to be more cautious in their reduction. So the fact that they did provide that type of number is pretty significant. That's down over 5 bushels an acre from what USDA projected a month ago. The bean figure at 3.05 billion bushels, that's a 41.4 bushels an acre. That's down from what the trade estimated of 42.8, but more significantly, it's down 2 full bushels from what USDA had pegged in July. USDA also lowered the harvested acres on beans by 500,000 acres. But this 41.4 bushels an acre, that's a dramatic drop for USDA to take in this report when we haven't had the most yield-sensitive time for beans in August reflected yet. And there's been, I would say there'd been a fair amount of debate in the trade as to whether soybean yield has been even that much negatively impacted by the heat that we experienced in July. So I think there, from in a relationship perspective, I would say there should be more shock about that bean number than there is about the corn number. The all wheat numbers for USDA for the U.S. crop, all pretty much in line with estimates. There's some changes in classes, but overall that's the wheat data was not that significant. Some of these report highlights that I want to talk about, I've already mentioned the soybean harvested acres, the yield. The soybean exports were lowered 95 million bushels. As we find down here, we're going to see that world ending stocks at 61 million tons versus 62 million ton last month. That's down somewhat, but 61 million tons of global soybean ending stocks, that's a large figure both from a historical figure and an overall raw data figure. So there's plentiful supplies. What USDA is saying when they lower U.S. soybean exports, they're saying the U.S. has a tighter supply. We're going to have to force buyers to shift demand to South America, but when taken in context of what the world ending stocks are, that should be no problem. And so, you know, there is some tempering aspect to this soybean data because of plentiful global supplies. USDA lowered corn harvested acres also by 500,000 bushels. The yield we've already talked about. Corn exports being lowered 150 million bushels. I think to some extent that is a reflection of the need to lower corn exports to have a workable supply in the U.S. I think it's also a reflection of what the global wheat price versus corn price is, and the what I would say is improved supplies globally for feed grains. And so with U.S. corn pricing itself in a manner that discourages as much as possible the export of U.S. corn and encourages global buyers to find something else to substitute for U.S. corn. So I think that's what that reflection is on the exports. And if this were a complete and total shock, that would imply that world soy price relationships, intermarket spread relationships, price of wheat versus corn was caught completely off guard, then the market would have a tremendous job in front of us to get corn prices up / get wheat prices down, but get that relationship moved in a direction that would force all this to happen. It's important to keep in perspective that these price relationships have been moving in this direction for the last few to several months, and so as far as how much work the market has to do because of today's report, just keep in mind a lot of this work has already been done through the form of intermarket spread relationships of, say, wheat and corn both on a global level. So that means that the reaction to this report can be somewhat muted because a lot of this work has already been done. World corn ending stocks for the next year down 1.2 million tons. That figure at 114, historically that's a relatively small figure, but the change from last month is not that significant. World wheat production up 10 million tons from last month. That's a big figure and a very plentiful figure. When you look at world ending stocks at 189 million tons, that's up about 7 million tons for last month, and that 189 figure is a very large historical figure. Plentiful supply should make it very easy to put wheat into the global feed ration and displace U.S. corn exports. Once again, a lot of this work that needs to be done based off of this report has already been done. It's an important item to remember. USDA lowered U.S. wheat harvested acres by 1.3 million, but yields were raised and carryout levels were virtually unchanged from last month. That pretty much sums up what I would consider to be the main report highlights, and I can't stress enough to realize that a lot of what this report says needs to take place in terms of price relationships to discourage U.S. corn use and encourage a cheaper global feed product in its place, and to discourage U.S. soybean exports and encourage those supplies to come from South America. A lot of this work is already being done and has been done. So the quick observations I want to take away from this is we have the backdrop now set for ideas. There's going to continue to be more pressure for U.S. corn acres next year. We're going to have South America needs to expand their global share of soy business. They have the supplies, they have the production capability. That shouldn't be an issue, but that is going to be a focus. Wheat needs to provide a limit to corn price, and it's already in the process of being able to do that because the relationship is already there. It may take a few days to absorb this bullish energy. This is something that I would have said before the market opened. Also need to keep in mind that corn prices with limit up gains today are not yet at new highs from something we've seen over the last 60 days. So when I first saw this report came out and before the markets opened, my first reaction was, well, that means we're going to have to keep prices up here for more than a day because the marketplace is going to want to probe above those levels of probing the new highs. I guess I still think that I want to say that, but I must admit that as I look at my other screen right now and I see that corn is only up 27 cents, which is not up limit, that is, I think that is quite a bit of a surprise. I think most people expected, and myself probably included, that we would have locked limit today and we wouldn't be trading like this until tomorrow. So I think that's interesting. We'll have to keep an eye on that. The other thing that that's worth a quick observation here is we are dealing with an overall commodity investment world that is different than it would have been several months ago. It's different than it would have been last year. And it's probably also different just in the last few to several weeks. This type of different investment environment where people are taking money off the table, not risking more, that also has the potential to limit follow-through after this initial wave of buying. It's also true that the trade as a total entity has been bullish corn for a long time. They've been unwilling to trade the short side. And so the market is already saturated with links. So once again, where's that new buying energy come from? Is it a situation where we got people who are already long want to add to it, or do we have people that are already long and they're just cheering and hoping somebody else buys it to run the price up so they can eventually get out? That'll be an interesting thing to see unfold here. But I think that the overall environment is not conducive to creating a trending higher market here. So producers still need to seek to capture opportunities, and still need to see rallies as selling opportunity, as a profit opportunity. And the mere fact that the market now has digested this report, the market is not trading limit up. We are at price levels that are below where we peaked at a couple different times here in the last 60 days. I think that's very interesting. Next thing I think that's important to mention is we need to respect history and we need to respect economics. A little bit later here I'm going to examine again 2008 through 2010. I think there's some lessons there that we need to remember. We've already talked about current price relationships being in a position to impact demand for U.S. corn, and I think some of the USDA data that's come out over the last few reports suggests that recent price levels achieved during this marketing year have already had a negative impact on corn demand, and it's clearly obvious that on a global perspective, world wheat is displacing U.S. corn export demand. So we're already doing some of this. It's also important to remember that this is only an August production estimate. We all see USDA change production estimates up and down in different years without any true clear consistency. So while the USDA was very aggressive lowering those production figures today, who's to say that in the end we find out that maybe the production potential wasn't lost as much as what we think. I certainly would be in that camp. I think that the yields are going to be better than what is implied by today's report, but time will tell. Initially, well, all you're going to hear about is how they might get lower, but just keep in mind that may not. There's the other side of the coin also. This is a spot corn weekly chart that I'm looking at here on the screen. If you go back here to just a second, I'm going to change my pointer option so I can draw on this thing a little bit. Right here, this area right in here, this is 2008. This is June, July 2008. Prices got to $7.50. If you remember, at that time, the euphoria was extremely high. Thought we were going to run out of U.S. supplies, global supplies, and didn't know how high prices could go. And keep in mind that part of what else was going on in this time frame is that was a time frame where you had crude oil at $150 a barrel, and everybody thought the last barrel of crude oil was on its way to the Smithsonian Institute because we were going to run out. So you had a tremendous amount of upward energy in the marketplace at that time from the speculative world and the investment world, and contrast that with what we have now in the investment world. So that's something to keep in mind. So here you got the 750. Notice in by the time you got to harvest in 2008, you had prices all the way back down here at that $4 level, and ultimately got down to, by I think in December, you got down here to about $3 or a probe of $3. And so in less than 6 months, you went from 750 to 3. And remember the environment where everything was pointing upward pressures on from outside markets, etc. Big thing to remember. Also, it's important to remember that from that period of time, all the way until basically until last year, when we found out that the corn yields were far below expectation, which was very much a late season understanding of what had happened, and basically when the combines began to roll. Prior to that, peak here in June, July of 2008, once the market broke, it took almost 2 full marketing seasons before the market ever got consistently back above $4 corn. So the point here is these exceptional historic prices don't always last long, and if the market does tip over, like markets tend to do, the amount of time it takes to recover is far longer than what you want to see or what you hope to see. And now if we shift towards this year, notice how the prices have been hovering in this price area for basically the entire calendar year. And despite floods, excessive moisture, despite planting delays, etc., we still have had a ceiling environment on this corn market for much of this year from spring forward. I think that's an important thing to remember. So today you've got spot corn up here trading just right here, just a little over $7. Keep in mind that earlier this summer we approached $8 for spot futures. You got December corn trading at about $7.15 as I speak right now, and keep in mind in relationship to where that is. So despite today's bullish numbers there, we're not anywhere close to the peak of this old crop market, and we're not even exceeding the levels for the December contract itself. So that's an important thing to remember. If we go to, this is the December 2009 corn, just thought I'd give you a little perspective. Here you are in June and July. Again, evidently this pointer option won't stay in that mode. Here you are in June and July at this $7 level. This was December contract. So spot contract was trading $7.50, but this was trading at around $7. And from there, we just steadily declined. By December of 2008, here we are trading at $3.50, and by I guess it was 09. By September of 09, we'd slid down to $3 on this 2009 corn. And if I remember right, 2009 is when we had all kinds of moisture problems and concern we weren't going to get the crop planted. Everything was late. But notice how the market had a very difficult time even getting above $4.50, and that's after recently being at $7 and having all kinds of problems in that next planting season, and the market still struggled to build any upward momentum. And so that's just a point of once things turn, regardless of what the reason is they turn, it takes a long time for things to recover. This is a spot soybean chart weekly. Here in 2008, you've got levels up here at well, you had a spike up here towards $16.50, but you spent a lot of time between, say, $12 and $15 on beans during 2008. And this entire calendar year, beans have been in a very small range considering all the type of volatility we have, on slightly more than $1 range, with most of that range going back and forth in a dollar trading range between $13, $14 beans. And I think there's quite a few different arguments that I could make about the bean market, but I'm going to sum it up and say this chart tells you that the market players are uncertain about the bigger picture direction on beans, and I think that uncertainty is based on a tug-of-war between continually declining U.S. soybean acreage, any type of production concerns, versus the other side of the tug-of-war being South American supply is expanding and having the potential to continually expand, and prices being at levels that will encourage that expansion. I think that translates into a soybean market that is unsure of how it needs to react to these bullish developments that come up out of U.S. supplies, but are offset by a very willing South American producer to capture that business. Spot weekly chart, on wheat, same thing. In 2008, we had a spike up there at 13. I think Minneapolis wheat got over $20 a bushel. It was very much a euphoric environment. The world found a way to increase supplies. Prices have been depressed. And here you got spot wheat. I made this chart yesterday afternoon. That was $6.85. Today you're trading slightly over $7. So keep in mind that we're still well off the highs, and this chart in and of itself is not that dynamic. And the wheat data in and of itself today was actually bearish. So to say that wheat prices can't erode back to where we were just several weeks ago would be a mistake. To say that wheat prices couldn't even erode down and make new lows down here at 550 would be a mistake to rule that out. The point here is all of this anchor is going to have an anchor effect on corn prices. So if you think corn prices are going to $8, the first thing you got to recognize is wheat's going to be a hurdle to that. And because corn is already at a relationship that is historically moves demand to wheat or away from U.S. corn, that's going to be a drag on corn prices. So I think that's an important thing to remember. This is a July 2012, so next July corn. And the reason I brought that up is I want you to see that going back from April when we had the spring anxieties about production, we got to $7, and yesterday we were trading $7 futures. So this is a lot of bullish news, a lot of anxiety and unknowns from the time we were having planning concerns to present, where the market has been somewhat capped. And if you look at these $7 prices and compare it to the chart I offered you a few minutes ago on the spot weekly corn, from a historical perspective, this is very high. Now today you've got July 12 corn trading up here at about 733. Limit up would have been about 38. So see, you're still not quite making new highs. I think if somebody says we're still going to go up and probe these highs, I certainly wouldn't want to rule that out. But I do think that this chart pattern, especially when taken in context of historical levels and the anchor effect of wheat, I think we should have a lot of skepticism about any ability to build prices up in any type of a uptrend here. I think we should have a lot of skepticism about that. So I wanted to show you that 2012 chart for that purpose. And the takeaway for a producer is, you know, how much upside potential do you have? And if you think you don't have much downside potential, just go back to 2008 when you're trading at $7 and in less than 6 months you're trading at $3.50. And at the same time, the bullish fundamental profiles were thought to be in existence throughout most of that decline. This is December 2012. I've talked about for the last several weeks about considering forward pricing of a multi-year type strategy. That concern and that focus was driven primarily by what I see in terms of an inflation, deflation, what I see in terms of economics, and what I think will be a subdued investor environment to sponsor commodity ownerships. So here you've got these 2012 that in June got to approximately 640 here, and several days ago it got to 650, and then we had a 645 in here, and I think we got to like 610 even going back into April. So as we speak right now, this December 12 is at 635. That's where we are right now. So despite today's bullish report, we're still not higher than this. And taken in context of historical price relationships and all the other things I mentioned, I think there's reasons to be concerned about this. And I think it offers downside risk. How much? I'm not sure. I'll make this statement that it will be difficult to get these deferred prices to get too low because, you know, there's still a strong appetite for corn. But who knows what's going to happen with government subsidies? Who knows whether the ethanol usage is going to be able to stay steady, whether will grow slightly, or whether a government change in how they subsidize ethanol industry causes a temporary cut in usage. Who knows? But it's not unreasonable to say that a $5 price for corn in general, or new crop corn, is to define that as a downside risk. That is not at all unreasonable. Is it fair to say that there's maybe real value at $5 and it'll be difficult to get values below that without some abrupt change in production estimates? That might be fair, but I think we need to recognize that you have at least that type of downside risk. This is a 2013 corn chart for anybody interested. Same basic storyline here. Going back into April, we were trading 590-ish, and we peaked out at just under around 620 up here. But you've got a lot of pricing here at 590 on up that makes these values look like they're at some sort of a ceiling. And if you think corn prices are going to go up, it may not have that much impact on 12 or 13, because as prices go up, it's going to cut back on demand, it's going to cut back on usage, and we have ample global wheat supplies, we've got ample global soy supplies, so maybe all that happens is the nearby months stay firm, capture, try to cut back usage. Eventually that reduction of usage will lead to price decline everywhere, but these new crop levels probably have some price ceiling impact. Once again, I still say that you have to respect downside risk of $5 or less, and I think it's not difficult to come up with the merit of having taking some forward pricing protection on 2012 or 2013. One of the biggest concerns always with forward pricing is, what are my input costs going to do? Well, with what's been going on with crude oil prices, which has a big impact on input prices for agriculture, I think it's fair to say it doesn't appear like we have inflationary concerns ahead of us, and we might actually have some decline in some of your input costs based on some of the energy costs. So once again, I think that draws me to the conclusion that it's not unreasonable and maybe quite warranted to consider capturing some of these profits for more than just this current marketing year. This is a chart of the Dow index. Notice the abrupt fall we had from 12,700 down to 10,500 here this week. That market's probably going to find some stabilizing activity. Certainly had an abrupt fall. Markets tend to stabilize. The question is, how much of a recovery can we get? The economic outlook looks somewhat dismal. You had much of this move here was created by Fed stimulus and expectations and hopes of improved economy, and certainly this last wave up here during the last year or so has been on optimism that we'd turn the corner. Now all of a sudden you get this dump in prices that, because we now are concerned that maybe we haven't turned the corner, and the raw data of unemployment and demand expansion has not lived up to expectations that were developed here. So now you've got a situation where you might be capped at this 11,500, 11,700, and you may have a situation, just because of how markets work, once trends get established, they tend to last for a while. Now you might have a situation that, is it fair to say, after going up for a couple of years and trying to anticipate and drag the thing higher, that now in just 2 or 3 weeks time, this is it, we've corrected it all, now we're just going to resume an uptrend? I think that might be unrealistic. So we may have a situation here where we can still see over the next 6 months this stock market to have some problems and be a weight on all investor sentiment for all markets. Spot monthly crude oil, this is a monthly chart, so up here you've got 2008 at near 150. The important thing to remember is we're going to run out of oil, and the bullish euphoria was unbelievable at this point.
Welcome to GoToWebinar, Web Events Made Easy.
Needs to be set.
Welcome to GoToWebinar, Web Events Made Easy.
Cited euphoric expectation may have it. And now you've got this thing down into the $70 range. Right now today you've got crude at over 83, but it's going to be difficult to get back above 90. And if you look at from a historical perspective, the amount of time spent up at these upper levels are small in relationship to the amount of time spent below it. You also had a situation throughout much of this period here where the trade expected inflation as the main backdrop. I don't think the inflation is the main backdrop expectation anymore. I think now they're just hoping we don't have deflation. So to say crude couldn't go back and trade $55 to $70 crude, again, I think would be a mistake. If this maintains some sort of a cap on rallies in crude, can't get above 90, some sort of downward erosion type of price pattern here, that should help producers' input costs. It will temper any bullishness towards commodity markets because of inflation, and it will tend to put a limit on how much, for example, the corn market can work higher, even though we have what we think are bullish fundamentals based off today's reports. The dollar index, here again, this has been a reflection of inflation or deflation expectations. The trade for the last few years, all you hear about is how the dollar is just going to get tanked and it's going to continue to decline and it's going to be a debacle, and that will lead to commodity price inflations. But here again, this is where the dollar index was in 2008. Here you got it 2009, 2010, and here you are right now, and the dollar index is at levels that seem to be a floor. Even going back here to 93, 94, you were at $80 on this dollar index, and now you're at 75. That's not a significant change, and certainly not near as weak as what everybody has projected it to be. I think that you can only press on a spring so long before you get a rebound in the opposite direction, and I think it's possible over the next several months, couple years, you're going to see the dollar index improve and get stronger. I think there are multiple reasons for that, but no need to go into those now. But that also is not as supportive commodities as what the trade has been thinking about. So that pretty much sums up what I think is important out of this post-report time frame. I appreciate your time and your attention. I hope you've enjoyed this webinar, and I hope it's provided some value. But I want to summarize it from a producer perspective. Job one is to focus on profit and understand what that profit is. Job two is to recognize how important that profit is to your operation. Job three is to recognize how today's profit levels compare to historical profit levels in this business. And lastly, respect the potential for the unknown to happen, and at the present time the unknown would be a reduction in profitability, a threat to profitability because of the overall economic environment, and a threat because the investor environment is taking money out of risky items, not putting money in, which is what the energy that tends to drive markets higher. We don't seem to have that energy. And as we speak now, corn is up 23 cents, wheat's up 29, wheat's up 15. If I said wheat, I meant beans are up 30 and 29, and wheat's up 15. And this is not the type of price action one expected at 9 o'clock this morning. Not that it's bad price action, it's up 20-some cents. But this is a statement about the lack of investment sponsorship and that lack of energy flow. And I think that's something very important to watch. And going forward over the next few to several weeks, we're going to get a better handle on what kind of yields are really out here. If you start to sense that maybe the yield crop is better than you thought, better than what the heat feared losses were, recognize that we're dealing with markets here that have a lot of downside risk and the potential to unleash a lot of liquidation pressures. So with that, Kevin, I'll turn it back to you, and thank you all very much.